The FOMC raised its policy interest rate by 0.75 of a percentage point, and we are strongly committed to returning inflation to our 2% objective.
Here, he's out-hawked the hawks here relative to where the market was going into this. The Fed is above where the market is for next year and the year after that.
What I think they're setting up is a situation where they actually put the economy in recession, and then, much as they would deny it today, they are eventually going to reverse course.
The Fed has now turned the ship around. It's doing exactly what they need to be doing.
And so now we've arrived at that moment of the yield curve that is truly flashing red for economic problems.
Every Dow stock is lower except for Walmart, just hanging in there. We're down almost 500 points. S&P 500 is down 1.65%, and that is just going to go out at the lows of the day as well. Every sector down.
Good morning and welcome to Bazaar Morning Call. I'm Anuj, with me Sonia and Prashant. As you saw in that montage, the Fed maybe having the last word. Yesterday we were saying that fed up of Fed, maybe the Fed didn't like it and just gave us a bit of a reality check. I'll put some basic points on table and then we'll take it from there. This is now the most tightening spree that the Fed has been since Paul Volcker in the 80s. And that's the big question, is this Paul's Volcker moment? Because the market's fear is that they did underestimate the rate hikes. 75 happened, and logically the market should have been relieved that it was not 100, but the commentary. And I think I just want to put a picture here. This is a picture that I read in the morning. This is the 50-year history of US monthly inflation versus the Fed fund rates. Why is that important? Is that once you start to cross a certain threshold, it doesn't come down till the Fed fund rates actually go over the inflation, or inflation falls below Fed fund rates. Inflation in US is at 8%. The Fed funds, even after the hike, are at 3.75. So I'm not saying that we go all the way there. Of course, inflation will also fall at some point. But that is the big worry. Back home, of course, we have been resilient. It's well documented that our market is best performing market. But does that get tested, especially with the way dollar index is also surging? Finally, do we participate in the risk of, I think, Sonia, Prashant, morning. This is the big question that I'm asking.
Absolutely. And so many questions, right? I mean, Anuj, Prashant, morning. It's the third straight big rate hike, right? 75 basis points 3 times in a row. There was this joke doing the rounds that why don't they just hike it by 200 basis points in one shot and then cancel all the Fed meetings to come, right? But I mean, Anuj, a couple of points stood out for me, and of course, Prashant will take it forward in greater detail. But the main message has not changed since the Jackson Hole meeting. That was the big statement that came from Jerome Powell. A 75 basis points rate hike has come through. There are more planned to fight inflation. The Fed is resolved to bring down inflation to 2%. So, until that target comes through, there are plenty of rate hikes on the cards. Of course, most global markets were under pressure, and the Fed could hike as high as 4.6% before ending the inflation fight. But a couple of big questions from an Indian investor standpoint, right? Now, since this Fed hike is out of the way and we by and large know which way this trajectory is going to move, will this bull market that we're in, will it resume in India now, or will this pause continue? That's the first question. Since the main message of the Fed has not changed, and remember, there was expectation that could be a 100 basis points hike, and since that has not come about, is it in some way a bit of a relief for markets like our own, which have been moving on their own, speed? So, Anuj, these are the big questions. I mean, now that this large event is out of the way, do you think the market will move on, or will it sort of, move in tandem with the global markets, take a bit of a pause? That's the million-dollar question, right?
It is maybe a billion-dollar question. Sonia, we don't know if the event is out of the way because we don't know how many more rate hikes will happen. So I think that is a big question. I think back home, we are going through the process because at the end of the day, you have to trade the Nifty at 915, right? Doesn't matter what happens overnight, SGX, Nifty and all of that. The big question that you have to answer is, what do you do when the markets open at 915? Now, our market has been going through some bit of cleanup of excesses over the last couple of days. It's visible on the Nifty, but more visible in the market breadth. Now, the larger trend has been buy the dip, and I think that's intact till 17,240 holds out on closing basis. That has been a very strong support for the market. So I think till that is there, the dip is a buying opportunity. For today, how do you approach it? I think for today, simply you keep the SGX Nifty low as the first reference point because what I have observed is on days like today, the market normally does not violate the SGX Nifty low. It does not open as bad. And if it does, then, in the first hour, it actually makes some kind of a low which does not get breached, because shorting after this kind of a decline is not a good risk reward. The market, of course, the Nifty opens below the 20-day exponential moving average, which is 17,700, way below that. So in terms of the next big support, that comes in at the 50-day exponential moving average, which is at 17,340. Yes, it's quite deep, but then, that's the kind of the market that we have. Intraday recovery, if it happens post the first hour, has to be led by the Bank Nifty, which is very strong. And I think IT index today could actually test its 52-week low. So in terms of the Nifty Bank, the first level to watch is the 10-day exponential moving average, which is 40,800. And then the 20-day exponential moving average, which is 4220. What I'm trying to say here is that in this zone, the Bank Nifty normally anecdotally bounces back and gives you a good risk reward. Whether it changes or not, we'll find out. But the market's message has been that if you buy in this zone, you normally make money. The FI data is very interesting. Yesterday, it indicated that after 3 or 4 days of short covering, shorts re-entered the system, not just via futures, but also via the options. I think that could just be a play for today, because today's weekly options expiry. So maybe that was playing for that gap down. And let's see after the gap down if these shorts cover or actually let them run till 3:30. I think that will be, for me, the fascinating story. But let's now revisit the big story. And Prashant has, of course, walked across to the big wall. Prashant, did you get some sleep? And what's been the key takeaways?
Well, thanks very much for that. So the big event is out of the way with largely hawkish implications. Let's get to it then, right? And I'll break this down in 10 points. So number one, the Fed has delivered a third consecutive 75 basis point rate hike, which is in line with market expectations and consistent with recent Fed communication as well. Number two, while there were no major changes to the statement, the summary of economic projections showed a sharp increase higher in the federal Fed funds rate. These are projections of what the Fed sees its own Fed funds rate will be by the end of the year, by the end of next year, and so on and so forth. Number three, the median for 2022 in terms of these rate projections was taken for the end of this year from 3.375, that is 3.4, to 4.4% nearly. What this implies is important. Consider this. This implies that the median participant on the FOMC committee is looking for another 125 basis points of hikes in the remaining 2 meetings of this year, that is November and December. That is significantly higher. Number four, the 2023 dot, which is next year, went from, these are, again, I'm saying projections for where the Fed sees its own Fed funds rate at. It went from 3.75% so far to new estimate of 4.625%. This implies another 2 hikes next year beyond what they expect the Fed to deliver by the end of this year. On top of that, the 2024 and 2025 rate projections show modest gradual normalization. They expect rates to come down to about 3.875 and 2.875 as well. But even these rates are in the restrictive zone. We're talking about 24-25. Number five, Fed Chair Powell's first answer to the question in the press conference was prefaced by him with this comment. But even before he took the question and began answering, he said, "The main message for me has not changed at all since Jackson Hole," end of quote. So he wanted to make sure that there is absolutely no confusion what the focus for the Fed is, which is fighting inflation and bringing it down to 2%. Number six, these are economic forecasts now. Just like there are rate projections, there are economic projections as well. They were also revised, but mostly in a more pessimistic fashion. Why? Number seven, unemployment rate projection for 2023 and 2024 is now expected at 4.4%. This is an upward revision of about 0.5% and 0.3% respectively. The other projection is the growth projection for 2023, which was revised down, while inflation projection was revised higher. So it's the opposite of what you would want to see. Growth is being revised lower, inflation is being projected higher, and rate forecasts are moving up as well. Number nine, Powell in his prepared remarks, this is the statement which he reads off before he takes questions, highlighted that the restrictive stance of the policy is likely for some time, and that history cautions strongly against prematurely loosening policy. This was the one big notable change from his July policy statement. Otherwise, there wasn't very, and this change is relatively at the margin hawkish. And last point, number 10, in the press conference in response to a question as to what will cause the Fed to slow or pause these rate hikes, right? Powell outlined three conditions: below trend growth, softening in labor market, and a clear evidence that inflation is moving to 2%. I mean, you know, to summarize, I would say that this meeting, this Fed meeting outcome has managed to surprise even the raised bar of hawkishness. The street and the market will have to play catch up with the Fed. Back to you.
Okay, thanks a lot for that. So that is the big event that took place overnight. We'll, of course, get you a whole host of experts to react to that and tell you how you should approach the Indian markets, which has been fairly resilient amidst all these challenges. The first call of the day comes in from Eric Fishwick of CLSA, who says that the Fed has raised rates by 75 basis points to 3.25%. This was expected, and this is the third back-to-back 75 basis points hike. The tone of both Powell's press conferences and the Fed forecast materials was hawkish, guiding for a terminal rate above what they and the market expected. With only 2 FOMC meetings left this year, CLSA believes that there is powerful signaling value in its 2022 forecast. The median forecast for the end of 2022 Fed funds rate has been raised by 100 basis points from the June meeting and now stands at 4.4%. They retain a forecast that the US dollar will peak before the year end, albeit not much before it.
Okay, let's get you some money market views then. Parul Mittal Sinha of Standard Chartered Bank says that the USD INR finally touched the 80 mark yesterday, with the dollar index rising beyond 111 levels, which is a fresh 20-year high. Post the hawkish FOMC, dollar strength has sustained while oil and risk assets are under pressure. She expects the USD INR to trade in 79.90 to 80.40 range next week. Apart from the dollar and oil, the extent of dollar sales by PSU banks is expected to drive the rupee. And I think that's a very important point. The dollar index is now, forget about 111, almost approaching 112. So that's, the market absorbed 110, but for long the market's fear was, does it go to 120, 125? Has it started? So 112 now has sort of negated a major double top at 110.
Okay, a lot of Asian markets as well at the moment are moving to the lowest point of trade, so don't lose sight of that. The SGX Nifty is now down 145 points, indicating quite a tough start for our own markets. But on the bonds, here's what you can expect. Parul Mittal Sinha says that the bond and swap yields have seen upward pressure in line with global trends. The Fed hiked rates as expected by 75 basis points with a hawkish guidance, driving further curve flattening. 10-year yield to trade in the 7.25 to 7.35% range next week, with the upside risks from higher supply in H2 FY23, tighter liquidity conditions and uncertainty on index inclusion. The MPC is likely to hike rates by 50 basis points next week, with the markets now pricing in a terminal rate beyond 6.5%. Okay, so this is going to be the big story of the day, undoubtedly, and we'll get you plenty of views to tell you how to approach the markets. But we also have plenty of stocks to track, so let's get down to that. In just a bit, we'll have our entire research team. We're looking at Fortis Healthcare, Ashoka Buildcon, Dodla Dairy, Heritage Foods, Triveni Turbine, Arvind and Gokuldas Exports. All these stocks on the back of positive news flow. We also have Canfin Homes, SpiceJet and Ambuja Cements that are likely to open in the red today.
All right, so that's basically what we have in terms of opinion and a lineup of what follows in terms of stock-specific news flow. But for now, since the big overlay is going to be global, let's spend some time talking about that. Ed Yardini is president at Yardini Research. He's joining us now for some commentary and some perspective. Ed, great to have you back on the program. Thank you very much. You know, the Jackson Hole left very little doubt in terms of what the Fed wanted to do, and the Fed chair emphasized that nothing has changed for them since Jackson Hole. In those many words, pretty much. What does the market do from here? Global markets. But, global markets are also doing things very differently, right? I mean, the U.S. is sinking. The Indian market, for example, is just a few percentage points away from all-time highs. So how does one read what's going on?
Well, I think in the U.S. there's continued concerns that tighter monetary policy will cause a recession. I think there's a tremendous amount of liquidity still left over from the pandemic. So I'm not expecting an outright recession. I think what we're going to have is more of the same. Let's call it a growth recession or a rolling recession that hits different sectors, different industries at different times. Even in housing today, we see that single-family housing starts are down, but multifamily housing starts are up. We know that the consumer continues to spend, though at a very slow pace. they'd like to buy more cars, but the auto industry is in a recession mostly because they can't get the parts that they need. So there's all this kind of mixed movements in the economy that I think adds up to virtually no growth. And by the way, the Fed's summary of economic projections is in that camp. They also believe that economic growth is going to be close to zero this year, and next year something like a little bit over 1.5%. So I think for the stock market, it means the market moves sideways with a lot of volatility, because I don't think earnings are going to take a dive, but they certainly have peaked, and I think they're going to go sideways for a while. And then I think the volatility is from the valuation multiple.
Ed, good morning. You know, we had a bit of a summer rally, right, in the US as well after the decline. Yeah. And the assumption was that at some point in 2023 the Fed will turn. But the problem right now is we don't know the final rate from where it will turn. I mean, and it keeps getting pushed, right? So do you think that will keep the uncertainty, and that will mean that perhaps not only the markets hit new lows for the year, but even go lower than that?
Well, I think that the 3,666 low that was made on June 16th will be tested, and I think it will hold, because I think that the earnings picture is not going to fall apart. And I think the valuation multiple certainly can go back down and as a result retest that low. But you know, we had a tremendous amount of pessimism at that low. I think a lot of people who were inclined to panic have already panicked. I might be wrong about that. There may be a whole another wave of panickers that'll take us to a new low. But sentiment was just so horrible back on June 16th that I have to believe that most of the selling has been sort of flushed out of the market, and that we're more likely to see a sideways movement, and that low will hold. Could be wrong on that, obviously, but I think that we're looking at a volatile market moving sideways, which suggests that it'll be good for traders. It'll be good for long-term stock picking, but it's not a momentum market, that's for sure.
Okay, it's not a momentum market, but I think what stayed with me is your comment that the stock markets could move sideways, but with some volatility, right? So you're not expecting a bear market or anything. What does that mean for a market like India? We've been doing exceptionally well. It's a 3-4% growth that we've seen this year. Do you think that is something that can continue, the outperformance of emerging markets versus developed?
Well, we've discussed this before, the idea that the global investors, when they're looking around, they don't seem to have as many opportunities. There are fewer safe havens for sure. And I think the United States is one of the safe havens. And I've been monitoring monthly capital inflows into the U.S. And over the past 12 months through July, they are basically at a record high of $1.5 trillion. Tremendous amount of money coming into the United States. A lot of that's been going into the bond market. I can't imagine how much higher bond yields would be if it wasn't for foreigners buying our bonds. They have not been buying our stocks. Now, India, I think, is turning out to be another safe haven. When people look around the world for where are there opportunities to invest in a market with some political stability, with some rule of law, they're getting to be fewer countries that fill those kind of requirements. India certainly is there. Europe has the rule of law. It's got political stability, at least domestically, but the international situation, the phase with the Ukraine situation is terrible, and their energy crisis could very well push them into a very severe recession this coming winter. China's got all sorts of problems with its property bubble bursting and with their zero COVID policy. So again, global investors don't have that many places to go. And India, from an emerging market standpoint, certainly is one. And U.S. from a developed economy standpoint is another.
Oh, yeah. I mean, returns in 2020, at least last year, 2021, 2020, U.S. and India were right on top, even in dollar terms, in terms of returns, almost matching point by point. Ed, just on the flow side, I mean, the dollar index is now knocking at almost 112. That's an important channel for flows into emerging markets. I mean, you want dollar low or not higher. Do you think it'll put pressure on currencies, even the stronger ones like the rupee? By the way, the rupee is one of the strongest currencies so far this year. But the fact is that the central bank here has spent a lot of dollars to keep it that way. Is that a worry at the margin at all? What's your sense?
Well, I think it always is a worry when you have these big, significant moves, and the strength in the dollar is extraordinary. But it's not surprising given the situation in Europe facing an energy crisis, with China having its issues. And because of that strong dollar, we're now seeing something that wasn't occurring for a while, but and that is, for a while there we had strong commodity prices and a strengthening dollar. That's not happening anymore. Now we've got a strong dollar and weakening commodity prices. And for a lot of commodity producing emerging economies, that's clearly bad news. And some of them have a lot of debts to China that now suddenly they can't meet and are trying to restructure those debts. So generally speaking, emerging markets are under stress as a result of the strong dollar and as a result of tight monetary policy of the Fed.
Finally, before we let you go, Ed, is there anything in the commentary of the Fed, in the speech, that makes you incrementally bearish on risky assets like equities, or is it just more of the same?
Yeah. Well, you know, the Fed does not have a great track record of being accurate on forecasting the economy, especially since the pandemic. I think very few people have really been able to assess where the economy is going now since the pandemic. So it's a very difficult environment to try to forecast. And I think the Federal Reserve has just come to realize since the beginning of the year that they completely got inflation wrong and that they have to catch up, that they've been behind the inflation curve. And I think they forgot the fact that we had tremendous fiscal stimulus. And now they're being forced to offset that fiscal stimulus with monetary tightening. And for the sake of their credibility, they have really no choice but to state that that's their number one priority. So no, I don't think there were any real surprises, except, as you folks pointed out, in the summary of economic projections, it turned out to be more hawkish than the markets were anticipating. And I think the markets scrambled in the afternoon to kind of catch up with what they were reading in that summary of economic projections.
Okay, Ed Yardeni, thanks a lot for joining in and making sense of all the commentary that came in from the US Fed. Pleasure speaking with you. So that's the opinion coming through. He expects the stock markets to move sideways with volatility, but no outright recession in the US. And the June lows perhaps will be held in the US. Let's see which way things go. For now, today is expected to be a day of bright red on the screen. So we'll slip into a quick break. Our list of top 10 stocks coming up. Welcome back. Hope you're having a good morning so far. The SGX Nifty is indicating that the start will be quite bearish after the US Fed meeting yesterday, but plenty of stocks to talk about, so let's get straight down to that. Anuj, what are you looking at today?
Sonia, the point I've been making for some time about the Indian IT, you know, the IT index has almost 0.8 correlation with the NASDAQ. And if you look at what the NASDAQ's been doing, it's almost approaching its 52-week lows. And back home here in India as well, the only large index in a confirmed bear market is the IT index. Now, you know, I was making this point that, you know, a lot of these stocks need to still throw out a lot of excesses of the last 2 years. Valuation-wise, still 30-40% premium compared to their median valuations. So in the large cap space, Infosys and TCS are very close to their 52-week lows. So I think that's something that obviously you keep an eye on. There's Infosys and there's TCS as well. And after that, I think you look at the broader market stocks where there's clear correction. I think this is one space where you don't want to catch falling knife. I know a lot of people say, okay, the stocks have fallen so much from the highs, you know, that's really being myopic. Birlasoft, for example, could be a stock where, you know, you could see maybe some more decline. And I think, I mean, there are a lot of them. Oracle is the other one. I think Oracle also very close to its 52-week lows. basically the IT stocks. And I think even I want to throw in a couple of these exchanges, platform stocks, kind of stocks as well, the new economy, digital stocks, because when we had that May-June correction, it was all about the valuation reset given the new rising rate environment. I think this is something which a lot of stocks have to factor in. I think you will see that over the next few days or so. All right.
Anuj, thanks very much. So those are stocks to watch out for. Now, for Fortis, it's going to be a very important day. That a decision on the IHH open offer is due. It's been due for a long time coming, and is likely today in the Supreme Court. Ekta is here with the implications of a potential decision. Ekta, hi.
Thanks for that. Well, yes, this is a story that we've been tracking all the way since the deal was struck with IHH in 2018 July. So the Supreme Court is going to be hearing the open offer, making a decision with regards to the open offer today at 10:30 a.m. Remember that the IHH open offer has been pending since December 2018 in the Supreme Court. IHH currently holds around 31.17% stake in Fortis. Now, to give you a background, IHH had bid successfully for Fortis at around 4,000 crores in 2018. IHH had to undertake an offer for 26%, which was at 170 rupees per share. Now, they had around 3,000 crores plus in an escrow account for the open offer. Now that 26% open offer was put on hold because the Supreme Court wanted to freeze the IHH deal as a whole. But remember that the deal itself had taken place in November. Now the company says that IHH has been committed to Fortis. They are not looking to exit Fortis because of this deal uncertainty, open offer uncertainty. In fact, the internal expansion was not impacted. So if in case there is a favorable outcome today, we could probably see expansion start for Fortis quite aggressively, and IHH has been committed to Fortis in terms of the expansion plans. Analysts say that the offer price for the open offer could be the earlier open offer price, which is 170 plus 4 years of compounded interest. So that comes to around 250 rupees per share, which is lower than the current market price.
Okay, thanks a lot, Ekta, for that. So we'll watch out for Fortis. But moving on, Abhishek has a couple of stocks on his radar. Abhishek, morning. What are you looking at?
Morning, Sonia. So let's begin with Canfin Homes, wherein they have given a press release saying that the board has accepted the resignation of MD and CEO, that is Mr. Girish Kosgi. So his last working day will be 20th October 2022. On the other hand, SpiceJet DGCA continues to keep SpiceJet under enhanced surveillance. They have put cap on SpiceJet till October 29th, so no festive cheer over here. And Ambuja Cement gets classified under ASM Stage 1, that is additional surveillance measure, and the stock has also entered FNO ban. Back to you.
Okay, all right, Abhishek, thanks very much for that. Now, Vivek is joining in with more stocks which have news flow. Vivek, hi, morning.
Well, good morning. Few stocks on the radar. The first one, of course, is Ashok Bilcon. It's on the back of an order win. Now, the company has received a letter of acceptance from a railway project, and this particular project is worth almost 258 crore. The other stock on the radar on the back of a block deal is Dodla Dairy. Now, Bharat Biotech International, very interesting name, has picked up a significant chunk as far as this particular company is concerned. The sellers were, certain amount of the shares were sold by the promoter, and also TPG made a partial exit. You're also talking about Heritage Foods, which is on the radar on the back of the fact that the company has announced a board meeting for fundraising via a rights issue. This board meeting is scheduled on September 30th. Lastly, Triveni Turbines, a company that we covered in depth yesterday, the details came out, and along expected lines, Triveni Engineering made a complete exit of their 21.85% stake. Triveni Turbines bought 10% stake, and other marquee names picked up the remaining 11.85% stake. Names include, the Adya Fund. You saw the Singapore government fund, California-based pension fund, as also domestic mutual funds picked up the remainder of the chunk.
Thanks a lot for that. Yes, we've been highlighting and yesterday got the confirmation from the management, and now it's official exchange confirmation as well. Vahishta has some more stocks in news. Vahishta, hi, good morning.
Hi, good morning, Anuj. Well, the rupee actually breaches its psychological mark of 80, and with this, the textile sector could be a potential beneficiary because of the strengthening of US dollar. The dollar index is actually at a 20-year high of 111. And in terms of textile companies, the export revenues contribution for Arvind and Gokuldas exports, both of these are in excesses of 50%. However, for these companies, a rising interest rates could be a likely headwind for the companies in the future.
Okay, thanks a lot for that. So here's a quick recap in case you missed out on any of the stocks. Stocks with positive news flow today. There's Fortis Healthcare, Ashoka Buildcon, Dodla Dairy, Heritage Foods, Triveni Turbine, Arvind and Gokuldas Exports. While stocks with negative news flow, there's Canfin Homes, there's SpiceJet as well as Ambuja Cements. But post the US Fed meeting, there's lots that's happened in the world of commodities as well. Manisha Gupta is joining in for a roundup of all the action there. Manisha, hi, good morning.
Morning, Sonia. Well, yes, the U.S. has hiked interest rates and spoken about further hikes as well, and that is weighing onto the commodity prices. The risk being that the major global central banks will continue to hike rates, and this may dampen the energy demand going forward. You have the crude oil prices, which have now declined below $90 per barrel. Yesterday, same time, we were trading at around 92 or 93, so it has been $2 to $3 of a decline in last 24 hours. The U.S. gasoline demand also has continued to decline. The U.S. crude inventories have risen, and that seems to be weighing onto the prices as well. Gold and silver have seen a knee-jerk reaction, but majorly seem to be trading within the range before the U.S. Fed rate hike as well. What has seen a decline, though, has been the metal prices. The global economic growth becoming a concern. The U.S. home sales have dropped for a seventh straight month for the month of August. And there has been a statement from Rio Tinto also talking about rising inflation, short-term weakness across metal space. So whether it's copper, aluminum, zinc, we have seen multi-month lows into these. Iron ore prices now trading at a 9-month lows as well. So it's difficult to find anything trading in the positive when it comes to commodities as a sector.
All right, Manisha, thank you very much for that. So that's, commodities which are likely to be under pressure as well. We'll take a very quick break here. Up next, Prakash Devan joins us for some fundamental stock analysis. Later, we'll also have the management of CSB Bank. Pralay Mondal has got a 3-year confirmation in terms of his post as MD and CEO from the Reserve Bank of India. That happened late last week. So we get chatting with him as well in a bit from now.
Welcome back. Well, we've been highlighting how the trade setup this morning indicates that we have a massive risk off in the global markets. The dollar index approaching 112. The SGX Nifty is off the lows. Let's see, normally on days like today, that is a very important barometer to watch out for. Prakash Devan is now joining us for some stock talk. Prakash, hi, good morning. The big highlight of trade yesterday was the selling finally in some of the Adani Group stocks and even some of the new ones like Ambuja and ACC. Your thoughts on whether they will now correct more, or is this going to be a buying opportunity, and how to approach these names?
Good morning, Anuj. So, yeah, I think it's finally a little bit of fatigue that's catching up. I mean, we've seen not just the cement names, but also some of the other businesses like Enterprise and ports start smartening up in the last 2 weeks. So there was bound to be some sort of a pause that it would take. Interestingly, what's happening to the ports business, the Adani Ports business, that's something which is actually going to take it to a very new scale structurally. And my sense is, the price still gives you that comfort of participating in that growth story. Adani Enterprises is sum of parts and can get a bit misleading and confusing. So I wouldn't really bet on that. But I think the cement names will eventually start waiting for some new triggers in terms of what's the final steps that are undertaken after the restructuring of the board and all the pledging and all is behind us. So you'll have to give it some time for the next leg of the rally to begin in the cement names, at least, especially Ambuja, which is the first one to get restructured. But my sense is ports on dips is definitely something that you could continue to add on the portfolio. In fact, it's not run up as much, but fundamentally it's doing the right things in terms of scaling up geographically and in terms of capacity in West Bengal and some of those other locations that we've been hearing of in the last few days.
Prakash, hi, good morning. I have many questions to ask you, but what tops my mind is the move that M&M made yesterday to acquire the remaining stake in Swaraj Engines. So they're, they're actually fortifying their core business, right? In that sense, both on M&M and on Swaraj Engines, does it make sense to take fresh bets?
Good morning, Sonia. So, M&M has been on a tear. So, I think the momentum will probably continue. It also was essential for them to start having far more qualitatively and quantitatively a bigger stake in this critical supplier. Because remember, Escorts Kubota is really shaping up in a very different way in terms of the farm equipment, landscape. The competitive landscape is going to change dramatically once Kubota starts flexing. So they've gone through all that restructuring, and if M&M does not up its game in that space and just keeps on focusing on the UV, portfolio, you could probably see a little bit of a sheen coming off. So I think it was the right move. Not that technically it makes any big difference to Swaraj Engines, but I think it's a critical supply to M&M. Yesterday we saw Swaraj Engines do so well. I think this was more like a win-win for all. Everybody went home happy in these transactions, all the three players. But you saw the news today on Kirloskar using that money to probably acquire or enhance their stake in one of the other machinery businesses out of Ahmedabad. So I think all that's played out pretty well. But yeah, on M&M. Specifically, this is definitely a very strong move in terms of capital allocation. You'll probably see the results of it in a year and a half's time from here on in terms of the capacity improvement.
Okay. Plenty of questions to ask you, but we also have a management joining in, Prakash, so request you to just stay on and listen in. CSB Bank is the stock on our radar. It's been under pressure actually for a while. It has now announced the appointment of Pralay Mondal as the Managing Director and Chief Executive Officer. This will be for a period of 3 years starting September 15th. Remember, Pralay Mondal was appointed the Deputy MD in February and he was the interim MD and CEO of CSB Bank from the 1st of April. He joins us now, to talk more about the business, which way things are headed. Mr. Mondal, good morning and thanks a lot for joining in your new role as MD of the bank. I want to start by asking you about the gold loan book because that's about 44% of your overall book. There's been some volatility over there in the recent past. Now, how are things looking and what kind of growth are you penciling in?
Thanks, Sonia. I think the gold loan book is doing extremely well. We had a journey, I think the entire banking industry had a journey because of the 90% to 75% LTV change which happened last year. And we navigated that pretty well. And right now, I think we are on a growth path. Of course, the global gold prices are slightly volatile. And of course, with the Fed rate hike yesterday, gold prices will remain under a little bit of a pressure globally. But because of the LTV is now at 75%, I think we have enough margins to navigate that part. And we are seeing gold loan growth coming back again. So we are pretty happy with that business. And in terms of quality of the portfolio, LTV, all of that, I think it is doing extremely well. So we are very positive on this business.
Mr. Mondal, hi. Good morning. Prashant here. And congratulations for that approval coming through. Just to stick with that, I mean, gold loans are about 42% of your overall loans, right? Now, on an overall basis as well, loan growth, it's a relatively smaller size book, right, for the overall bank. Loan growth has been kind of tepid, 7-8%. In Q1, it's picked up. What should we sort of pencil in going forward for FY23 and beyond? I mean, what really are your plans in ramping that up?
Thanks, Prashant, for your wishes. Yes, I think we do understand that gold loan is a relatively larger component of our asset book. But that's not how it will stay over the next decade or so in the bank, because what we're doing in the bank is looking at a much longer term perspective. How do we want to build the bank? And there we will have gold as one of the key levers of growth in the next few years. But the larger growth will come from retail SME and then also wholesale by the end of this decade. So the way we are planning things out is, yes, we will grow faster than the ecosystem. And the credit growth in the industry is around 15-16%, and I think it will remain there. And we think we should outpace that in the next 2 to 3 years, including this year. So on your first question on growth, I think we are looking at growing much faster than what we have done in the past. The second part is how do we do that? Of course, we'll build the retail engine a lot more. That takes 12 to 18 months to build because you need to create a lot of systems, processes, technology. So we are completely changing our tech stack. We have got a great CTO with us. And we are, as we're talking, we are looking at changing our core system, our workflow system, the entire surround system, etc. So once we have that ready, a lot of people are joining us on the retail side and SME side as well. So we are building that franchise. So at this point of time, next 18 months, we will be able to sustain what we are doing. We have this concept of SBS 2030, which is sustain, build and scale 2030. So we'll sustain for the next 18 months and then grow based on retail, SME and wholesale.
Actually, on the retail side, there is quite a bit of weakness that we've seen in your own portfolio. I mean, your retail loan book was down about 14% in the quarter gone by. What are the measures that you will take to grow the retail book and what kind of sustainable growth do you see there?
See, Sonia, I mean, I have done retail all my life. So let me tell you that the retail book which we have is a vintage portfolio that's just running off. So don't read too much into what is happening in terms of negative growth because that's running off. What is more important is looking at the future, what you're trying to build. And that's where we are going to have all products and services in the bank, some directly within the bank, some through partnerships. For example, credit cards will launch next month through partnerships. We are doing home loans ourselves as well as through HDFC Limited. We have, and we are building a lot more partnerships, both on the product side as well as on the fintech space. So given that perspective, I think what we have to see is next 12 to 18 months is a build phase. And 18 months onwards, you will see a lot more growth in the retail side. And retail is a journey and it will have an uptick. So net by FY 2030, we have planned our balance sheet. 30%, the largest book will be from retail, 20% will be from gold, 20% from SME, and rest from all other businesses, including wholesale. So retail will be our growth journey, but we want to do it only when we are ready with the entire tech stack.
Mr. Mondal, you've got a deep-pocketed promoter. So any discussions with them in terms of strategy, etc.? They're also, by the way, Fairfax has also been interested in the entire privatization drive, for as far as PSU banks are concerned. If something happens at that front and say they acquire a PSU bank, how will any discussions on how this will play out? Because they're banking. I mean, I'm assuming they'd like to have one banking business here.
So, Prashant, let me first answer the first part of your question, which is what is the role of the promoter in the bank? Of course, they are almost 50% of the bank in terms of holding. So they have 2 board seats in the bank, and they do contribute and they do participate in the bank strategy through the board on an ongoing basis. So that's part A. Part B is Fairfax globally would know, of course, they are deep pockets and we are like a very small in their overall ecosystem globally, but we are important. That's what I hear when I went to their AGM in Toronto, or when Prem came here a few months back. I think what I picked up is India and banking ecosystem is an important part of their strategy, and we will play that out. And hence, yes, they have deep pockets and they will support us in our growth. The discussion which I have with Fairfax is primarily on how to organically grow this bank. I mean, for example, I'm investing into the core system and some of the other surround system, etc. So if we have been discussing margin and acquisition, we wouldn't have been investing into this. Having said that, what they do or what the market speculations are, neither I get involved into that discussion nor I can comment on that. But what I can do is me and my team is purely focused on how to grow this bank organically. And if something happens the way, we'll figure out how to handle that.
Okay, any inorganic plans to acquire any bank?
We don't have, CSB don't have any plans at this point of time to acquire this bank. So what Fairfax is thinking of doing, that is something I cannot comment on.
Okay, all right. Well, on that note, we will let you go. Thank you, Mr. Mondal, for joining in, and all the best in your new role. That is the new MD of CSB Bank. The stock actually in the last couple of months has done quite well. It's gone from 180, which was the low in June, and now back at 240. Let's slip into a quick break. On the other side of the break, Mitesh Thakkar and Sudarshan Sukhani will join in for some technical trades. Stay tuned.
Welcome back. Well, the SGX Nifty is indicating we'll start 130 point lower on the Nifty future. 17,586 is what we have right now. For the low of SGX Nifty futures is 17,553. So just about 30 points of that. The market's texture has become slightly weak over the last couple of days. We have Sudarshan Sukhani and Mitesh Thakkar now joining us for fresh trades. Gentlemen, good morning. Sudarshan, the market was all over the place yesterday. I mean, it's clearly been so indecisive looking at yesterday's data. And this morning we have a gap down. How do you approach it?
Morning, Anuj. That's why we were not keen to buy till 16,650. A sharp dip was available. And today, the same theme applies. The market is in a trading range between 17,500 and 18,000 roughly. Now we are very close to 17,500. So while the market decides, while the Nifty decides whether 17,500 will act as support or whether it will break down, that process could continue throughout the day. And yesterday's choppiness and, as you said, all over the place market could be a pattern for the day today also. So I don't think we want to enter this market today. If 17,500 holds well, then maybe tomorrow would be an opportunity. And if it breaks down, then I assume that a much deeper downtrend will start. So today is a day to observe. I wouldn't trade either the Bank Nifty or the Nifty.
Trade either the Nifty or the Bank Nifty, and 17,500 is that level to watch. By the way, there's that massive block deal which has happened on Bharti, which 9.4 crore shares at 772. It's happened in the block window. So again, is that the Singtel block? Most likely looks like, and is that been bought over by the promoter entity? We don't know, but that's a big block which happened there. Mitesh, good morning. How are you approaching trade today?
Morning, Anuj. See, yesterday, towards the end, we had taken some short position on stocks. I think broadly the idea was that with the last hour closing on the Nifty, the indicators were slightly on the weaker side and we closed below the intraday hourly averages. So I think there is a chance that we might see and head towards the lower end of the range. Now that could be around 17,500, 2,530 zones, or in the worst case, 17,400. So I think we are preparing for a retest of the lower end of the trading range. And then, from there, we'll look for some kind of reversal signal on the upside. I think similarly, on the Bank Nifty, you might see the Bank Nifty also test supports of 40,900 in the opening trade. If that breaks, then 4,300, 4,500 range could be revisited, which for me would be a great buying opportunity on the Bank Nifty per se. But I think 1 or 2 days, I think market will be slightly negatively biased.
Okay. What about individual stocks? Mitesh?
Yeah. So I have 3 sell calls today, given the fact that the market will open gap down. Britannia is the only buy. It's a conditional buy. So if it crosses 37.80, buy with a stop below 37.50 for targets of 38.60. And on the sell side is Berger Paints. Keep a stop at 6.30, look for targets of 6.02. Bosch is a sell with a stop at 16.800 for targets of 16.340. And GNFC is a sell as well with a stop at 697.5 for targets of 6.50.
Okay, Britannia is the only buy, rest sell calls. Sudarshan, assuming you will have more sell calls as well?
I have a mix of buy and sell calls, and the reason is this is not going to be a downtrend. It could be a correction in an ongoing uptrend. I do not think we are entering into some kind of a bear market, and corrections are always difficult to trade. So the trend is still up, and if we have a correction, then there will be some difficulty in going short also. So Berger Paints is my intraday short. It's surprisingly the chart which was going up has suddenly turned down. Berger Paints is a short with a stop above 642. Bharat Forge is a buying opportunity. Now the stock yesterday was a little dull as was the market, but still it's a buy with a deeper stop at 737. GAIL is another short sell. The stock sometimes deceives and says, okay, I'm going up, but it doesn't. It eventually starts coming down again. Intraday short with a stop above 91. And finally, M&M is a buy. It's more of a positional buy than an intraday buy. Keep a stop at 1250. I think it should do well.
All right. Thanks very much, both of you, Sudarshan and Mitesh. Appreciate you joining in with those ideas and those trading strategies. We'll take a break here. There's 4 minutes to go for the pre-open session. Sumit Kishore of Axis Capital joins us next to talk about a bunch of things, actually. We've got the new electricity policy. We also have the government funding to create high-efficiency solar PV modules and the implications of that. Stay tuned for that chat.